Hello, hello. Good morning, good afternoon. Let's see. Hopefully, we don't have any technical issues. All good. Are you guys able to hear me? All right. Audrey says yes. That's cool. I'm not sure if, everything that's on my end is okay. If you can say something, say hello.
Good morning, Vivek.
Hey, morning, morning. How are you, Tom?
Great,
Hello.
thank you.
Yeah, I like the your background, man.
Thank you.
Uh,
It's not real, of course, but
yeah.
topical at least.
Yep. I mean, as many screens as you can get.
That's right. The more the bigger.
Yeah.
Unfortunately, there's not a correlation between the number of screens you have and the profit you make.
In fact, I think I tweeted somewhere. I similarly, I found a picture of these eight screen setups and all that. I mean, I have two screens, and so it tweeted. Now I got eight screens. Now I can lose eight times faster.
Good one. Just, I'll be right back. Hang on.
Yes. Uh, all right, guys. So what I got for today? How about it? So we got 17 people. I think yeah, folks are just joining in. Sorry. Yeah, we didn't meet last week because I was away on Thanksgiving break. We were meeting some friends. So, but good to be back. Back in schedule. We have what 4 weeks remaining? A little less than 4 weeks, and can't complain about the markets this year. Right, pretty good market so far. Hopefully, nothing bad happens in 4 weeks, and we'll all will be fine. But yeah, nothing to complain about. Life has been good. Uh, so this is also a time when I start looking at the how I've done in terms of tracking some numbers, some metrics, etc. So we'll start sharing those maybe next week or week after that because anything can happen. We have some major events coming up in terms of Fed announcements and all that stuff. So maybe I'll wait until the penultimate week to compile some of the metrics I would like to share. You know, I'm a big fan of tracking the stuff. So I do track certain metrics around my own performance. Yeah, if you don't know your numbers, you don't know where you'll end up. So I can't control what the market will do, but I sure want to know where I am. Right. Hey, morning, Aditya. Good to have you. So what do we have for today? Let me share my screen and we'll go from there. Anything else? What caught your eyes? You know, what did you see in the markets? What do you think? Any new stuff you learned this week?
Uh, there's something on Seeking Alpha. Someone's suggesting to buy Zscaler, and so I'm kind of enthusiastic. I think I bought a couple shares back in the day when it was down.
Hmm. Yeah,
Zscaler.
yeah. There are these group of cybersecurity companies. A lot of people get excited about them. I've never owned Zscaler. I don't think I have done spent enough time to understand the company. Just because basically I own CrowdStrike, and I didn't feel the need to add any other in my portfolio yet. But Zscaler over the years, I mean, it has a little wild ride, if I remember. I mean, let me just bring up Zscaler chart. ZS, wow, it's currently sitting at what, almost 30% drawdown. And over the years, 2, 3 year, it's back where it was maybe at the end of 2023. So it's almost 2 years worth of performance got wiped out on Zscaler.
So Vivek, I was too greedy on buying the low of Palantir and Nvidia, so you just get a couple shares in case it spikes. That's what I learned. I mean,
Oh yeah, I mean, if
buy a couple shares.
yeah, if you like the business and you think the company is good, I mean, you could size in, but I don't size in on my first trade. I basically step into a trade, and if it continues to go high, that's okay with me. I don't have to get too greedy. But I guess everyone have their own way of investing in terms of how you want to scale into your position. But I generally take at least 4 or 5 trades before it becomes the position, the full position for me. So, but yeah, Zscaler is, I mean, if you're interested in Zscaler, it's available where it was at 2 years ago. So, not a bad time, not a bad time. But I have never owned Zscaler. I mean, I have a couple of friends that have in Zscaler, but I also, I don't know. Has anyone done a deep dive on Zscaler? Any other owners of Zscaler? No? All right. So Sam, you'll have to tell us something else about Zscaler. No one else owns, looks like. All
Well,
right, Aditya is asking, it will be useful to know what are some good metrics to track from your perspective. So few things that I track is in terms of my win-loss ratio. Again, these are just for me as an individual, right? I track what's my max drawdown has been, what's my best day, worst day so far. That I can share. I think my worst day was just after Liberation Day. In one single day, I was down almost 8.66%. And my best day so far has been, I think, the 9th of April. I was up like almost 17% a day. So there are a few things that I do want to track, right? So drawdowns, and volatility and all that stuff. So maybe I'll share. Niyanka is saying Netflix new shopping spree, Warner Brothers. Yes, WBD. But I think it's a time before the deal will close, Niyanka. I think the deal is supposed to close in 2027. I don't know how the regulators are looking at it as well, but Netflix also has given up and it's down almost 30%. Yeah, almost 30% from its recent highs. So it's sitting in 30% drawdown. I have not owned Netflix. I think maybe first time I had owned it was 2019, 2018. And then during 2022 cleanup, I actually had sold Netflix. I've not owned after that. Uh, but yeah, it's better to own it at 30% discount or drawdown than maybe at a high. So if you're interested, may not be a bad deal. I might if a spot opens up on my portfolio, maybe I'll put it on my watch list. Just that it trades in conjunction with the rest of the tech companies. And for now, I personally don't want to add any more tech exposure to my portfolio. And Netflix correlates, with basically QQQ or the other tech companies. But good to put on watch list. A 10 for 1 split. Yeah, they did the split and Netflix becoming good option play. Yeah, because now, there are a lot more traders, especially one with the less capital, like typical Robinhood traders. Now they can trade options on Netflix because now your nominal price has now reduced by the factor of 10. So instead of $1,000, now it's $100 share. So that's the only thing that changes when a company split the shares. Other than that, there is no other meaningful change for from a business perspective or from a stock etc perspective. Right? Market cap still stays the same, just that the stock price has split. But that enables a lot more people to start trading options, etc. in it. What else? So Netflix. Anything else? before we get into today's session. CLS. What the heck is CLS? Celestica. Wow, what do they do? I don't think I ever looked at CLS. I don't think anyone brought up CLS. Let me just pull up. What do they do? Supply chain solutions in okay. No, I've never the idea in terms of what $37 billion market cap. Um, and doesn't pay dividend, but continues to do some buybacks, have some free cash flows. Almost $1 billion of operating income, $700 million net income, and trading at 37 billion market cap. It's pretty expensive, right? Yeah, it is. It is expensive as a from a company perspective, but decent growth. Does generate free cash flow. I would say it's expensive, but it is not like egregiously expensive. Now I don't understand. I mean, it's business or what's the competitive mode they have. Um, but I mean, it's not super duper expensive like some of the other companies. So Ray says, think about selling. If you, I mean, if you want to capture profits because you have had some gains, sure, we'll have it some decent run from this year. YTD, it's up almost 252%. So I don't think anyone can blame you for selling at this point of a time. You may want to, if it is too much too soon, I don't understand. Where business doesn't seem to have grown that fast, but maybe it's got a AI somewhere in it. And it does talk about advanced technologies and connectivity and cloud solutions. So that's what maybe, uh, you know, has caused this run up of 200% in the stock. Any thoughts on current valuation of PayPal and SE? So PayPal has been trading at a very attractive valuation, but that doesn't mean the stock will go up. Market may take its own time to revalue PayPal. But the way they have been buying back shares, using all the cash to buy back shares, I think it's still at an attractive valuation. One concern which could be on a PayPal, I was listening to Shopify, some person in finance department on, they were in some, I think Goldman Sachs or some other technology conference. They were talking about how they're expanding into payments in outside of US, in Europe, etc. So that's one area that could be, they may be entering into PayPal's territory. And PayPal currently only have payment solution, but some other companies like Shopify, etc., can provide a full suite of solutions to merchants. So if I'm a merchant who's trying to scale its e-commerce operations, yes, PayPal comes up with a great payment network. But if Shopify comes along and say, hey, you know what, we gonna give you all the other stuff to manage your business, and payments also, shop pay payments also comes along with it, that's a good competitive position against PayPal. So that's something you need to look into. But just looking at the financials, PayPal seems to be at a very attractive valuation right now. But that's all looking at the the historical data of the financials. So I am, I still hold PayPal. I sold some. I'll talk about it when I get to that section of what did I buy or sell. But the reason is not the valuation. The reason was something else for me to sell. SC, I mean, I like SC. I don't think anything has changed from a valuation perspective on SC. After the previous, the recent quarterly results, I know shares, the stock hasn't performed, but I didn't see anything that is cause of a concern for me on SC. So I am still, mm, from a business perspective, I think I'm still good with SC. I mean, they had some good traction on both on the Garena side, which is the video gaming plus, as well as money on the financial side. So nothing concerning about SC, at least for me. Also in cybersecurity, consider Sentinel-1. Sentinel-1, Tom, I had kind of a traded way back in, I think, 2020, whenever they came IPO, right? Not immediately after IPO, but a few months after IPO. But Sentinel-1's, the differentiation, what I found in my understanding of Sentinel-1 was it was like a cybersecurity for, oh, sorry, it was like a CrowdStrike for small and medium business segments, right? So while the CrowdStrike was focused on getting the enterprise accounts, Sentinel-1 was focused on a little lower segment of the market, small and medium business side of the house. But then I also saw CrowdStrike moving into that segment with their new offering, what called Falcon Plus. I forgot the name of that offering. And then they made it really easy for the small and medium businesses to basically, renew it, or kind of a lot more self-servicing, so that the CrowdStrike sales force or their sales team doesn't have to spend a lot to service this segment. So once I saw CrowdStrike also focusing on small and medium business, I'm like, you know what? I'm not touching Sentinel-1. So I don't think I traded Sentinel-1 after when it was $50 or something. I don't know where it is right now. As Sentinel-1. Now it's $14.
Those are all very, very valid points. Their last quarter was good. They had increases in recurring revenue year over year that were above expectations. Their revenues beat for the prior quarter. Of course, everything is about guidance. That's how stocks trade. And that's why it was down. I thought guidance was a little bit weak. There were a lot of analysts downgrades and price target reductions on Friday. But those are the kinds of things that often make for a washout. It had its second largest daily volume since back in 2023. So I think there's a fair degree of capitulation there. And I like to buy those situations that are oversold. Also, if you look super long term on the chart, the lowest that's been is around that 12 and a half area. So downside from here, I think is pretty limited. Also, it has been mentioned in the past as a potential takeover by a larger cyber company. So I'll just put that out there. Not that I buy stocks for that reason, but it's just something to share that I'd heard previously.
Cool. Yeah, I mean, it's been trading at almost what, the lowest valuation ever, or
Yes.
close to the lowest one. Yeah, yeah. Yeah, just that I'm not too keen on its. I was not convinced from its business perspectives. Maybe the stock may be a good buy, but I'm not yet convinced that the business may be a good buy. So, but if you want to take a short-term position on it, short duration, and want to do a swing, yeah, I mean, it's available at one of the cheapest price in the last 3 years, almost 3 years.
That's just for a short-term trade, looking for a bounce.
This is what I hate, right? $900 million of revenue. It just looks like they've been buying revenue, and you're still losing like 50%. And almost $400 million of $300 million of negative operating margins. So this is very expensive. I don't know if they can turn themselves around. Maybe possible, but with CrowdStrike moving into their arena, seems to be tough. And not to mention that they've been diluting a hell lot of their shareholders. Just that I just don't like the business numbers. But yeah, it could be from a, like you said, could be a short-term swing trade, etc. Yeah, someone wants to take that, probably could. Not that I want to play. Yeah, Sam, you had your hand up. Question, comment?
Yeah, I'm looking at where I'm gonna go eat.
Which one?
I'm looking at where I'm going to go eat, and Habit
Okay.
Burger has raised prices. In other words, prices are going up at fast food restaurants.
Yeah, that's not a surprise. Prices. I don't think that should be a surprise for anyone. The official number may whatever they want to, but
Habit Burger is owned by Pepsi.
yeah. All right. Looks like no further comments. So let's get into today's discussion. So welcome everyone to our discussion number 302 for our Saturday investing dojo. Today I want to take two big topics. Of course, we'll cover a little bit on the macro side and crypto and all that stuff. But two big topics that I have on schedule for today is number one is looking at a break-even revenue as a valuation framework. So I I list, Professor Damodaran, he recently released a video in which he talked about it, and I thought that's another interesting way to look at a company's. It's similar to kind of a similar to reverse discounted cash flow that I have talked about earlier also. And when I review the company valuation, I do bring in that, but it's not exactly DCF. It doesn't focus on the cash flow, but it goes one step deeper and focus on the revenue. So we'll look into that, how to use it as a valuation framework. The other thing I want to talk about is option spread trade and how it can spring. Sometimes it can spring some surprises for you. Not in terms of, hey, you lost more than what you thought you could because it's a spread trade and you know exactly maximum amount that you could lose, right? Not that surprise, but a surprise from a tax man perspective, right? I think I've covered earlier in terms of how some of the folks get shocked because you thought you could lose only $5,000 on a $50 widespread, but you ended up losing $20,000, right? I've already covered that case in some of our previous sessions. Today I want to cover the case which is not losing on option trade, but something that you could lose a lot more money on the tax side. That I want to talk about, and we'll give you a peek into my portfolio pizza. This is the first time we are meeting after the end of a month, and as always, I'll show you what are the top 15 toppings in my portfolio pizza, and we can have some discussion. What do you own in your portfolio? What are your top positions in your portfolio? We'd like to know that. And why do you own that? We may be able to find some businesses that I have not looked at, right? And maybe that's a great business to look at because you own it. You have your own bullish thesis around it, right? So that's a few topics that I have. Anything else in your mind? Right. As always, anything that we discuss here is only for education. So don't go and trade based on, hey, Vivek talked about it on Saturday. I'm going to put that trade on Monday. Please don't do that. All right. So let's start. First of all, let's start with thought for our mind before we get into the trading. So as I mentioned earlier in, I think one of our previous sessions, I was reading this book, 1929, Inside the Greatest Crash in the Wall Street History and How It Shattered a Nation, written by Andrew Ross Sorkin. I love Andrew's work. He's a great journalist in terms of, not only in his writings, but also in terms of interviewing people. So recently, he is also a host of The Deal Book. So, and I think the deal book happened maybe a few days ago. So right now there are a lot of videos, you can find it on YouTube, of Andrew Ross Sorkin interviewing the CEOs. A few of them which I saw was Brian Armstrong, CEO of Coinbase, and Larry Fink, CEO of BlackRock. They both were together on the same stage. Right? I would never thought that we'll see this day when the crypto and the TradFi stalwarts are sitting together, and Andrew Ross Sorkin was interviewing them. He also interviewed Alex Karp, then Mary Barra. All those interviews are available on YouTube. Just search for Dealbook Sorkin interviews. But coming back to the book, so a few takeaways I want to share with you from this book. Number one, today we are all accustomed to quick updates on our trading platforms, right? I want real-time updates with the microseconds. If the google.com/finance updates the data 20 minutes late, and we feel pissed off because, oh, that's not the latest one. During 1929, the market fell so violently. The ticker tape used to be manually updated. Of course, there were no computers. So there were folks who were employed who will go to the ticker tape and, with the chalk, they will update the price of what the securities is being traded at. And because the shares were changing so violently, the ticker tape was like 4 hours behind in terms of reporting the prices. And those are the prices then the rest of the country, traders in the other states would use. But those were like 4 hours behind. Margin trading was rampant, right? It's not just Robinhood or some of these neo brokerage firms that have popularized a little bit more riskier side of the trading, which is using margins. Many middle class Americans open margin accounts, putting down only 10 to 20%. Like they were levered up to almost 90%. And there were firms who would actually offer money to mom and pop traders to take margin and speculate in the stock market, right? So margin trading is nothing new. It was there in 1929. It has always been there. In fact, in 1929, Fed actually had sent out a word of caution. Fed wasn't really very active at that point of time because Fed was also new. Fed was formed in what, 1913, right? Or 17, somewhere like that. So they were not very active. They were also a little bit scared of their own reputation. So they saw that the market was going up and up, and they kind of sent a note to the bank saying, hey, tone down, go slow in lending to these speculators or traders. So, but it was rampant. Right? Third thing which surprised me and shocked me was that the investment pools were actually legals, which was like this, like a group of big investors will come together, figure out, okay, this is the stock that we want to pump. They will start accumulating the shares, and it will artificially pump the price. There's a word which is called like moving the tape, right? It will artificially pump the price, and the general public will look into it and say, wow, that stock is going up. They'll buy it, and then these groups will dump on it. So there were many so-called investment pools, and very like multi-millionaire of those days, very famous investors / traders were part of these groups. And those were guys like some CEOs of some banks or some fund houses, right? So, but it was pretty legal to do this thing, which is, sitting today, you'll be shocked that this insider trading was actually legal. Basically, pure pump and dump in a legal form. Other thing, RCA. What is RCA? Anyone knows RCA? What do you think was the RCA? Don't Google it. This was the latest tech of that time.
Radio Company of America.
Radio Corporation of America. You got it right. So radio was the latest tech, right? That was the AI of 1920s. New technology allows you to send the message to the whole country. Anyone can listen into it. So president can talk to the whole nation, even though it's one-way talk. So that was like amazing tech, just like the LLMs of 1929, and the stock exploded, right? So this was like a Cisco of 1920s. It exploded from being $1.50 in 1921 to 1928. It was like $85, right? Or you call it as a Palantir of 1920s. It was purely a speculative mania, and that in 3 years it was down to $10 in 1931. Other thing that stood out is we always hear about this 1929 crash. It wasn't a flash crash. It was a slow, I would say, death by thousand cuts. The market continued to bottom, and it didn't bottom until 1932 or 33. It was like a 4 years of painful bear market that the market went through. Anyway, National City Bank, which now we all know as a Citibank, the Citi Group, it openly defied the guidance from Federal Reserve, right? I was earlier talking about the Federal Reserve gave a guidance to the banks saying, hey, slow down on this speculative lending. There's a character in the book called Charles Mitchell, who was like a CEO of Citibank. He openly defied it by actually keep lending the speculators so that this bull market continues to stay alive. Charles Mitchell tried to defend himself, saying, guys, if I had not done it, the market would have crashed and many people would have lost a lot more. So he, he continued to lend money to some of the speculators. Among the wreckage, we also saw some good things that came out of it. One was Glass-Steagall Act, right, which basically separates the investment banking and your commercial banking units. The FDIC was formed during this time, and it was actually included in the Glass-Steagall Act. And now FDIC was not created. The thesis behind creation of FDIC was not to protect investors, depositors' money. It was actually created by, it was pushed on by these big banks to protect themselves. So if you really look into the history, it's so amazing that things have transformed or changed. It was not done to protect the investors. And the senator Steagall, no, I think Senator Glass, it was his bill, and he was not happy that the formation of FDIC or creation of FDIC was added as an addendum into it, because it was diluting his bill. Anyway, then also the SEC was formed. There was no SEC addendum, so there was no rules. It was a wild west. When the shares were, the companies wanted to offer the shares to the public, there is no S1 document, there is no prospectus. You may be lucky if you can find a leaflet about what the company does, right? So it was all word of mouth. It's wild west. Do what you want to. Just like I would say crypto was 5-7 years ago, like in 2017, you saw the whole birth of ICOs in crypto, right? Similar to that was how the stock market was in 1929. And interestingly, we talk so much about 1929. There are many books written about 1929. The crash didn't even make the front page of a New York Times. That wasn't a big story because the panics and the crashes were considered normal events. Today, if the market goes down 2% in a day, CNBC, Bloomberg, financial media, and Wall Street journals, it will be front page news. If the market goes down a couple of percent point in a day. During that time, it didn't even make to the front page of a New York Times. It's a normal part of a business. So pretty interesting historical account. I enjoyed reading through. I've seen some YouTube videos. I've heard about 1929, the crash of 1929, even though it took 3 or 4 years for the crash to materialize. But this is, I think, the closest you could get to the people who were living through that, right? It's easy to say yeah, I'll be able to survive, 20% drawdown. But when the drawdown hits, then we realize how difficult it is. So for me, it was vicariously living through the lives of the people and what they were going through. There are accounts of Jesse Livermore, the famous short short seller, probably one of the famous short seller of all times, and what he went through it. Interesting book. Start. I'll share it. With that, the book that I'm reading right now is Big Mistakes. Basically, this is the best investors and those best investors' worst mistakes. So, right, it's you don't have you can learn from either committing your own mistakes or learn from the mistakes of others. I just want to make sure I can learn from mistakes of others. So, currently, I'm reading this book. Maybe once I'm done, in some of our next sessions, I'm gonna talk about how some of the great investors made a few mistakes and that cost them dearly. Right? So, and every time we have to be cautious against our own hubris. And today's last whatever the market has done in last 3 years, I see this like all around on Twitter. Screenshots of flashing them up 200%, 500%. Like, looks like there is no one like below more than 100% gains. Yeah, if you're not up 3 digits, you're like a moron in the stock market, right? Doesn't happen, long term doesn't work that way. So be cautious. And I'll bring up in how some of those great investors, how they lost everything. They went over their skis. Right? So that's a book. Any book you recommend? What are you reading? Any book readers? What I've realized is rather than, being more on, some of these social platforms, there's a lot more knowledge. And that's just me to be gained from some of these books which talk about the history of financial markets. To me personally, going through the history helps me a lot in terms of preparing for a future. So that's why I love some of these historical books. Anything else? No one is reading anything? Dave said, do you read every page and jump around to find the key points? I actually want to read every page of the book. You know, I'll probably, even when it comes to the earning transcript, if that stock is a decent amount of my portfolio, which means if it is more than 2% of my portfolio, I actually go through the whole transcript. I tried using these LLM summary, etc., but haven't. They just you just don't get the whole gist. You just get the summary, but you don't get the emotions or the reason behind those summary, which is what I want to know. So yes, I do read through the every page of single every single page of these books. How to Make Money, William O'Neill. Yes, I think I have read that. It's a good book. Just started the corporate life cycle. Yeah, I think that's a great book from Ashwa Damodaran, right? And we do see many the companies today are displaying the various phases of life cycle and how they are trying to change. Uh, you know, they are trying to either change the behavior and behave differently than the age that they belong to. Just finished Range. Which is this book? Range. Let me take a note of this. Cool. All right. So let's. It's David Epstein. Dave, say if you ask AI to draw a summary on top 10 trading books you read, will it come to same conclusion? I have no idea. All right. Sometimes the books are like reinforce some of the same concepts, right? Which is good. I remember, I think in 2023, I read a book, Engines That Move the Market, which is basically the history of new technology starting from 1960, sorry, starting from 1600s, like 400 years ago, and it covers all the way till internet technology, right? And how the various, how every, with an advent of every new technology, we have seen the booms and the bust in the market. So when I see what's happening today, oh, come on, it's not new. A lot of people say, oh, this is unprecedented. And I think someone has already has said, saying, in the financial markets, those who don't study history, for them everything is unprecedented. Now there is nothing new happening in the markets today. You know, the 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 method might have changed, the technology might have changed, but these things have happened over and over again. Dave says, Sam's like you are semi-retired, have lots of free time. Dave, for the last 3 years, it's almost 2.5 years since I gave up my job and focus and became a full-time investor. So this is my full-time work. And I wish I should have done that sooner, but there's always a time to pick up something new and do what you really want to do. So yes, this is my only work. Melody say, I'm reading the Little Book of Common Sense Investing. Yep, that's a good book. Is that Joel Greenblatt's? I forgot. I think I read it 3-4 years ago. Anyway, so last thing for our mind is an interesting chart that I saw somewhere on Twitter. I think from Charlie. He puts great charts. If you are a fan of looking at charts, Charlie of Creative Planning, he puts great chart out on Twitter. This is what caught my eye in terms of S&P maximum intra-year drawdown versus end of a year total returns. Right? So when we say S&P has given up on an average, gives up 10%, right? But if you really look at it from 1980s, I think there's only 1 year where we got 10%, right? It's always up and down. More importantly, it's not that it's going to give you 10% average starting from January and go smoothly like this, right? The investing journey is not that smooth. It's like a sinusoidal wave. And this is where even we saw it this year also. These are the intra-year drawdowns, right? Intra-year drawdowns before you could actually enjoy the gains by the end of a year. And this makes the investing so difficult. This is why, most of the people don't invest. And I didn't invest until I had to work on my own emotional aspect of investing. In 2024, or sorry, in 2025, year to date, 18% market, I think, including dividends. And this was taken somewhere, yeah, including dividends, 18%. But we had 19% drawdown in the market. Right? 2020, market did 19%, but you had to go through that COVID drawdown of 34%. Right? Imagine getting despondent at seeing your portfolio down 20%. There are very few people who can hold through that volatility. Right? Many will just chicken out. It's not for me. You see your portfolio going down 20%. Let me say what is remaining, right? And you'll sell off, and then you can't enjoy the gains. This is why investing is simple, but it is very hard. It seems like an oxymoron. How can a simple thing be hard? It's not complex. Unfortunately, we try to make investing very complex. You can make as complex as you want to, right? But it can be very simple also. Just buy 2 or 3 funds. You don't have to own 50 positions like I own. You don't have to do exotic instruments like futures, like some of our friends do here. Free is a great futures trader, or don't have to do options, which many of us do it. You can just buy 2 or 3 ETFs, international bonds, S&P 500. Want to venture out, maybe pick sector specific, but that's it. But it is not easy because emotionally you have to go through these drawdowns. And this chart illustrates it very nicely. To get to this 26% gain in 2009, you have to go through once in that year, you have to see your portfolio down by 28% from its all-time high. Right? So again, a reminder, if you really want to be invested in the market, these drawdowns are the, I would say, the price that we pay. This is the ticket charge that we have to pay to get an entry into the club. If it was easy, everyone would be investing. It is simple, but is very hard. Right? Yeah, trade, like Nick says, trading is simple, but it's not easy. I'm not even talking about trading. It's like trading involves a lot more emotions because you like make a lot more decisions. This is just buy and hold S&P 500, not even anything else. Right?
Looking at this,
Rutvas, is great to learn. You are a full-time investor. I'd like to pick on ahead on your experience and journey. Sure, maybe we can get into one of these breakout rooms and we can talk lot more details into it. But I've been investing on along with my job for almost since 2013, and then became full-time investor on 2023.
Vivek, looking
Yeah,
at the
Sri.
chart that you have or the page that you have, the information that I gather is to wait for the opportunity to get long only when you have significant drawdown. You can consider 10% as a drawdown, 20% or 30%. And from that point, if you take into consideration how much returns you would have, 18% higher for this year and 19% down, if you add those two together, you would have 40% or 50%, somewhere close to that. So it is always a good idea to wait for the opportunity. Right now, the market is only 1 to 5% or 10% at the most. It has not gone down to 10%, but that is not the right time to try to buy and add to your portfolio. I'm in the process of reducing my total portfolio at this point and waiting for the opportunity when the market goes down 10 or 20%.
So I'll just add one thing which I think in one of our previous sessions I've covered. There was a chart that I brought up, which was, I think, 3 kind of investors. Maybe if I'll try to search, maybe I'll find it somewhere. I think that talked about 3 kind of investors. One, that regularly invests like a DCA, right? Discounted, basically continue to do your average, right? Other investor, which was investing only at a 10% drawdown in the market. And then the third one was at a 20% drawdown in the market. Or maybe it was like regular investing and then 5% or 10%. Contrary to what we think the result may be, the folks that were waiting for 10%, 20% drawdowns performed lot worse than those who were continuously adding, doing DCAing on their portfolio. The reason, and I don't remember which session was it, but the reason of that was because the market generally doesn't go down that much. And number 2 is, and that was on like an empirical study. And if you waited to invest, only at that the drawdown point, you actually missed out on on the long periods of time when the markets have gone up. That's an empirical study. Now, what I also want to add on to is the emotional part of it. If you see the market is down 19%, 20%, Shri, you're an experienced guy. Most of us, we will freeze. We'll be scared to death to put any additional capital in the market when we see the market has gone down 15%, 20%.
And especially if you don't have any more cash to put in.
Yeah, exactly. So it is very difficult. So I think for like common, for every for common people, I think it's both empirically and emotionally DCAing into the market is probably the best one. Right? Have there been times when someone had sold and raised some good amount of a cash, like in 2022, like both the stocks and the bonds, everything was down, right? And maybe in October 2022, if you had cash available on the sidelines and you loaded up on that cash at that point of a time, sure, life would have been great. But in October 2022, we had no idea whether this is bottomed out or not. And even in this one, I both in 1929, the book and the book that I'm reading currently, there have been instances of investors where they thought, okay, now the market has fallen down 20%, now I'm gonna go bull on it. And then the market fell down 20%. After that, it fell down again, another 30%. So it's very difficult. It's emotionally it's very difficult. I think the more years I spend in the market, I realize there's nothing about IQ. You don't need any IQ. It's all about EQ. That's define the difference between successful investors and those who lose money. It's all about emotional
Again,
stability.
if you take a look at that as a standard deviation, 8 to 10% drawdown and 8 to 10% of return is the normal range in the market. It might not go down by 10% all the time, but the upside is 10%. On the downside, it can be as much as 49%. But again, you should try to not put everything at one time. You need to be gradual. You need to take some out when it is positive. You have 18% so far. You think it is going to go to 30%? It's already last 3 weeks. It's not going to go up there. I doubt very much if the market is going to exceed the high of the year so far. So that's my attitude and that is my thinking, and waiting for it to go down by 8%, and then try to get back in if I choose to do so. I don't have to wait for it to be negative for the year and then get in.
Sure. I mean, I guess everyone has to find their own sweet spot which they can stick to. So while you were,
I put a link in the chat. This is a guy who follows that guidelines. He waits for it to come down and then he gets in. He does not put a stop loss. He is willing to take the complete risk and he makes good money by doing that.
okay. All right, so I found the chart that I was earlier referring to, right? The empirical study around market timings. There are a few, there's just not one, but maybe, there are a few other things about market timings. But this is what I think we covered in some of our previous sessions, right? Timing the market, perfect scenario for buy low, sell high. Start at 10K, sell at all-time high, move the cash to 3-month T-bill, reinvest if only the market fall down 5%, 10%, 20%, right? Sell high, buy low. This is how the portfolio would have done starting from 1973 till 2024. Selling at new high, this one is like 5%, 10%, 20% decline, which is I'll sell it at all-time high and then buy back when it's down 5%, 10%, 20%. This is what if you're steady invested. And this is based on hold on, investment in S&P 500. Academically, theoretically, no one can dispute this. But what we don't include in this is in terms of how the market general trajectory is. The reason these have underperformed is because you don't get many of these 20% decline on 5% decline that often, right? And that money is sitting on the sidelines, sitting in a T-bills and earning very less. So this is why I am not don't focus on timing the market. There have been many studies around these. This is what generally what we talk about is trying to do a swing trade. This chart is basically you always invest at the lowest point in the market. You invest when you receive the money immediately. Dollar cost average, worst possible means you're investing at all-time high. And this is when you're frozen and you don't invest anything and you stay in T-bills. Even if you invested in the all-time highs, right? You haven't done that bad. So the idea is to stay invest. I think there are a few more charts around this. So basically, market timing doesn't work. It only works on YouTube and not Twitter. Long term, it's almost impossible to make the market timing work.
Vivek.
Yeah.
But we don't buy the market because I made that mistake. My mother was telling me don't time the market, and I told you this before. I bought HP, back in 06.
Yeah, you didn't buy the market. You bought a specific company. Then you need to follow that specific company.
So, I mean, because we're buying specific companies. We don't time the market. We can't do that. But the thing is, for a naive investor like me, you have to be specific. Like you said, a specific stock in a specific sector has different circumstances.
Yeah. So if you're a new investor, I mean, don't even try to go on a specific companies. Should always focus on biggest diversification as much as you can. You're not going to make that much money, but then you also won't going to have that much volatility and may not lose that much money. I think it's important for us to actually see some positive gains before we try to swing for the fences to get some confidence. And I mean, I can only talk about my own story. I didn't touch individual stocks until I was like 6 years into investing. Mostly it was like ETFs. I didn't touch individual stocks. Individual stocks, I started doing it maybe 5 years ago. Right. And because it takes a lot of time. And I didn't have time along with my job. I only focused just buying 6 or 7 ETFs. That's it. Short term, yeah, someone can swing trade. Yeah, but I think long term, it's very difficult to time the market. Like I said, listen to any of the so-called great investors, right? Not subscriber hunters, but the great investors who will give you knowledge for free. Howard Marks, Warren Buffett, or even the two ones. No one times the market. And they admit that it is impossible for them to time the market. And here you and I, we are talking about, yeah, I can time the market perfectly. It's a dream. Could you be successful once in a while? Sure. But I think that's more luck than brains. That's my thinking. Have I been lucky in the markets? Sure, I've been lucky in the markets many times.
Which ETF were you in? You said you have 6 ETF you trade.
So when I started my investing journey in 2013-ish, 12-ish, so I started with S&P 500. And don't go there because I was like new to the US market and okay, I should take some real estate. So I also had some real estate ETF, but 6 or 7 ETFs that if I can remember, that was S&P 500, EFA, which was international, EEM, which is emerging markets, GLD, which was a precious metal, gold. Then I had some bond ETF. I don't think it was TLT, but some Vanguard bond ETF I had. So I got bond, and then I had a real estate. I don't know why I did pick real estate, but I did pick some real estate ETF. And then there was some materials, some one more. And I used to do my dollar cost averaging among these. I had decided that, I'm gonna put 50% of my investable capital into, let's say, S&P 5. I don't remember what the percentages were, but that's all I did until I think in 2016 I started learning about options. That gave me a little more confidence, and then I started pick more ETFs, starting picking a lot more sector specific ETFs because those are a lot more optionable. And then I started venturing into individual stocks.
Hey, Vivek,
Yeah.
quick question. So, would you say the average retail investor like us, trying to manage our own portfolio, would underperform or overperform the
Overperform what?
the index? Like, if we just put the money in the SPY, if we're trying to manage our own money, would you say like 80% of us trying to do it will actually lose money versus just putting it in the index?
I don't. So I'm not to talk about retail investors. If you look at SPIVA report over the long term, 10-year, 20-year long period, 80% of the Wall Street managers underperform their own index. I'm not telling, okay,
Mm-hmm.
focus on S&P 500. Let's say if you are a mutual fund manager, or if you are which is let's small cap mutual fund manager or small mid cap mutual fund manager. Over 10, 20 years, you have underperformed your own Russell 3000 index. If you are a large cap mutual fund manager, you have underperformed S&P 500 over last 15, 20 years. 80% of them. Forget about retail investors. The people who have billions of
Exactly.
dollars, who have access to the best reports, have access to the best technology, have underperformed index.
I agree. So, Steve, you think about this, right? We're all investors. We're all trying to make money in the markets. That's our number one goal, correct?
Sure.
That's all we want. We just want opportunity and we want to make money. So, is SP 500, correct? I don't know if people know this, but there's so many ways to trade the S&P 500. We'll just say at the start, you can trade the SPX, you can trade the SPY, you can trade the ES, which is the futures, of course. You can trade the micro ES. You can trade, and then not only are there different ways to trade that, but then there's different strategies you could trade the SPX. So
Sure.
instead of looking at like the different stocks and different, patterns, like why don't people just look at the SPX?
Like it looks like it got dropped off. It's connection. Yeah. So I think this question was, why don't people just focus on SPX or S&P 500 and then no, stick to that? And which is a great question. Why don't people just buy S&P, SPY and stick to that? Because we think we are super smart. We always attracted to the next shiny object. And during, sometimes that work too. Right.
Yeah, so we could just whatever our goal is, like work backwards. If our goal is to whatever it is, you can create any financial goal and just use the SPX or SPY or futures or options on those products, and then try to reach your goal trading just the market versus trying to jump around.
Yeah, and I would rather say that don't even try to do. I mean, for retail investors, for someone who's not doing full time, don't even try to do, let's say, futures. I mean, it depends on. I mean, you could definitely do it. I've never done futures. I used to do options along with my job, so I should not say that you should not do it, but you should understand how it works. And
totally. Like
spend
specialize
time
in one thing. Like even
in
with
understanding.
options. with options traders, right? Like, there's 30-day, there's 1 month
Oh, yeah,
options
yeah, yeah.
on the
So,
SPX. Then there's weeklies, and then there's 0 days. So depending on your time frame, your goals, there's a product for that in the
oh,
S&P. Like, there's so many different ways to trade it.
so financial market, especially US capital market, is the biggest supermarket of the world. You have to go and find out what works for your health and eat that. Don't eat what I'm eating. Right?
Yeah,
There
just
will be
focus on the
products on
biggest
the
market. Yeah, just focus
there
on the
are
biggest
products on the
thing.
shelf. There are products on the shelf. Some are packaged very nicely. Some are packaged in the shiny package. You might get attracted towards it. Read in the label. Understand what you're buying or what you're trading in. Don't blame the supermarket for, oh, I got burnt here. Why the heck they
Yeah,
SEC
yeah.
allowed to
Just
sell this?
just focus on market. I feel like because there's so much selection, so much stocks, there's so much strategies. Like, it just confuses the average investor. It makes us hurt
Yeah.
because we're our own worst enemy, right? We're like, oh, I should have done that. I should have. Just focus on the S&P 500 and its derivatives and the different strategies you can do it, the different time frames. It's all there for you in the SPX product and
So,
its derivatives and
so
strategies.
most of us, we don't understand ourselves. We try to understand the market and the stocks. We need to understand first ourselves and what works for us.
Exactly. Just be good at that one thing. That's all. I feel like too many people get too distracted with too many things. I was that. I was like that until I finally simplified it. Now I'm finally finding
In
success.
2020, and those who've been attending these discussions since 2020, I had 110 stocks in my portfolio at some point of a time. I simplified it. I think I still need to simplify it. I'm now less than 60. I mean, some of them are dust, which is like less than 10 basis points of my portfolio. I'm not even looking at that, but I'm like, I still need to simplify it further. Yeah, we all learn, we all grow in investing. Anyway, let me go through some comments. Dave says, I followed you and added some melee around 2000, but what happened Friday? Dropped 79. I know. So I on Friday, very recently, why the saw some weakness in Melly, because they raised 700 some million through a convertible, no, through a bond offering, which I think is the right thing to do. The market might have spooked the market saying why they're raising debt, but see, Melly is moving into a big business around capital lending. So they need to have the availability of a warehouse capital to raise the capital at a lower rates. Very recently, not very recently, a couple of months ago, Melly's bonds were graded at an investment grade category, right? These some of these rating agencies will give you that BBB, AA rating. So Melly for the first time was rated as an investment grade. Melly debt was rated as an investment grade. So it makes sense for them to retire the old debt and raise money at a basically at a cheaper rate. And they will need this cash because they are expanding their lending business and the credit card business very at a crazy rate. So that might have spooked some of the investors saying, oh, why they are like raising this debt, but I don't think there's any issue in it. And again, when I look at a Melly, it's like an Amazon. You need to have a 20-year long horizon, 20-year period on which you want to own these businesses. So I'm not bothered about the stock price going up or down until it is associated with a weakness in the business, which I have not seen on Melly. Market has given us opportunity to own Melly at very different point, right? I think in November 2024, it was available at $1,700. Market unjustly punished it. And I added at that point of time. I also added it very recently when it was like $2,000. No, even less than $2,000. So I added it recently. I still like the business. I've not seen any weakness in the business. So I will still hold it. But my outer is like, I'm going to hold this company for next 20 years. But if your outlook is not for 20 years, then you figure out then we are playing a different game. Then you can't follow me and I can't tell you what you should do. We are both playing a different game. We are in the same, I would say, stadium, but playing a different games. All right. Let me move forward. We're almost an hour into today's session. We got only 90 minutes remaining. And we haven't yet started. Okay, I'll come to the comments later. But let's look at the TradFi side. What's at a macro level? for the next week or for the next 2 weeks, this is what we should focus on. Could move the markets. Number one is Fed rate cut after December meeting. Meeting is, I guess, next week. And market is pricing in almost 90% probability that we're going to get 25 basis point rate cut. Could we get 50? I don't think so. But it will be a shock if we get 50. So, but this is what market is already pricing in, that we're going to get 25 basis points. If we don't get it, that will be a short-term pain in the market. Number two, we're going to get a labor market numbers, right? November non-farm job reports will be due on December 16th, will provide us some clarity on labor conditions. The ADP report, but that was around the private employees, wasn't that great. But we'll see what the official number comes out to be. Saw a tweet around recent layoff announcements, right? Doesn't start good. US government 300K, UPS, blah, blah, blah. So labor conditions has not been that great, right? In this year. Third thing that you need to watch out for is Santa Claus. Will Santa Claus come to town? Historically, 3/4 of the time, December has been a good month. This is what's called a seasonally, it's gonna get a Santa Claus rally, Christmas rally, or, pick up or whatever words you want to pick up. Sometimes it is performance chasing by fund managers. Again, this year, most of the fund managers have actually lagged the market, have lagged S&P 500. There was questions around, can we do better than this? Maybe we can do better than this, but most of the fund managers so far are lagging the markets because the market has become so concentrated among some of the few big winners that if you didn't own those winners, doesn't matter what else you did, right? If you did own some of these big winners, it's very difficult to outperform the market. And another question is, will some of those funds will try to catch up? Will there be catch-up trade, which will bring Santa Claus rally to us? And probably that's what happens most of the time. That's why historically 73% of the time, December is generally a good month. And looks like on average, it does what 1.28% up in December. So we'll see. Sometimes, we don't get, selling may go away is another seasonal saying. But this time, if you are sold in May and if you went away, you have lost out a lot of gains on that side. So yeah, could we end up into the remaining 27% when the December didn't do good? Sure, possible. Third, record earnings. S&P 500 operating earnings are on pace to hit 13 in new high in 2025. Now, if you are wondering why the markets continue to go high, there is a reason. Business has also been performing well. It's not only emotions, right? The earnings are up like 13% year over year. And the S&P is up what, 17%? I think justifiable, right? Not too far away from, you can justify earnings, growing earnings at 13%. So market is up 17%, not too bad. It's not up 70%. That would have been irrational, completely irrational. Are there companies, are there pockets of market where there is irrational exuberance? Sure. That's why if you're investing in individual companies, you really need to know it. But overall market doesn't seem to be that, it doesn't seem to be publicious. What else? Now these are operating profit margins. Looking at so far, Q3 of 2026, 96% of the companies have reported, and operating profit margins are 13%. Real wages are rising after a long time. Now, after a 25 consecutive months of negative, now we are seeing some real wages have been 29 consecutive months of real wages, which is after accounting for inflation. Other reasons to be bullish. We have this biggest technological boom since internet, right? AI. We're gonna get a new dovish Fed. I think Kevin Hassett is gonna be the person. Didn't Donald Trump says he's gonna announce it soon? I think maybe by end of this year or maybe when or before end of the year. Yeah. Then we got a capex coming in, $700 billion of tech capex. End of quantitative tightening, which is important. We talk most of the time we talk about Fed rate cut, which will take towards easing, but this is also end of QT, right? Deregulation initiatives by SEC. We're gonna talk about one of them during the crypto innovation exemption. We got a $2 trillion of annual deficit spending. We already talked about this. And then return of global fiscal stimulus, money printing. How can you be bearish? There are reasons to be bearish. Sure. Market is already up 17%. This year, it was up 26% and 24% in the last 2 years. Historically, we haven't seen this performance continue. That could be one reason to be bearish. Maybe the AI trade is overextended. I think that's it. Could be the biggest one, which, if this bubble breaks, the AI bubble breaks, it's gonna bring the house down. That could be a reason, right? But so far, I don't think we're in that bubble category yet. The companies have been doing good. The big companies that are committed for expenses are doing good. Could Oracle be one of the canary in the coal mine saying, guys, we're raising too much of a debt? Sure, but then don't buy Oracle if you're concerned about Oracle. This year, we also had a greatest comeback after worst 66-day performance. Right? We were down price return after first 66 trading days. It was the fourth worst since 1928. Almost 97 years. It was the fourth worst, 3-month return, which was negative 15. And this is what you have to go through the drawdown of negative 15% return in the first 3 months. And then we are looking at 17% gain for the year so far. And markets have come back roaring up. So you decide what you want to do for your own portfolio. I'm still holding positive deltas on portfolio. In fact, I've added some more deltas in portfolio. I've become less bearish than I was, I would say, at the middle of the year. Middle of the year, I was little more, I wouldn't say bearish, I was little less bullish than what I am right now. Does that mean I'm putting every capital at work? No, I don't know what could happen in 2026. So I'm starting planning to make sure that I don't have to sell my favorite stocks in 2026. If I need for a cash, I raise it, do some tax loss harvesting, and stay invested in this market. No one can time it. I can't tell you when the market will break. I don't think anyone can tell you when the market will break. Some will be lucky. There are people who have been screaming for that the market is gonna, all hell is gonna break loose and market is gonna crash. They already predicted, I think, 20 crashes in last 5 years, 10 years. One day they'll be, they'll be proven right. But if you had followed them for last 5 years, it would have been a much worse situation. So you figure out what works for you. What else? Next, I want to talk about option spread trade and some tech surprises that may be involved in it. But any other questions? Let me see on some of the comments. So Melly, we talked about timing market works wonder on short term. Yeah, that's what the swing trade is. But I've never met someone or who have been a long term, been a great investor for a long period of time and have come and tell, okay, I made money in swing trades. Right. They say always sell puts according to my chart support level. Yeah, right. I think bullish on AI in front. Okay, CLS. Dave, I don't quite agree with not timing the market. Traders died all the way looking at technical chart analysis. Yeah. There are people who are able to time the market. We are talking about, the normal, normal retail investors. Stan Druckenmiller has been a great timer of the market, but there is only one Stan Druckenmiller. Right? For most of us, we want to play in the game where we have more chances of winning. Right? And I don't want to make it more difficult than what it should be. So you figure out what works for you. I'm not dunking on anyone who's a day trader or who's a leverage trader. If that works for you, great, stick to it. You are built for that. I think my only request to each one of you is first understand yourself, then try to find investing strategy or trading strategy what works for you as a person. What works for Dave may not work for you. What's working for me may not work for you. I made the mistake of trying to follow all different people before I realized, oh, he's got a different body structure. The medicine for him is not going to work for me. Right? So anyway, so let's talk about an option trade. And I want to caution because this is the tax season is coming up. And especially this year, I've been very focused on at least not give anything to Uncle Sam through my capital gains, right? So been focused on doing tax loss harvesting, etc. Then I realized that an option spread trade could spring you some surprises in terms of tax consequences. Right? Not that you lost more money than what you thought you would. That's a use case that I've covered in some earlier session. But how even though it worked exactly the way it was supposed to work, but you lost a lot more because of the tax consequences. Anyone gone through that issue? Now I started to notice these things because I'm focused on tax. Right? So let's take an example. That's not me. I never bought Tesla at $50. But it's a hypothetical example. Let's say you bought Tesla in early 2020 when the stock was trading at 50. Where the stock is trading right now? 450 or something like that. Right? Congratulations. You're up 9 times on your initial investment. And if you're like me, you will always have some option trade in the play on the holdings, right? Maybe you want to acquire more of Tesla if it goes down, so you have a short put spread, and you did a spread because you want to limit your losses. Great, because we can never tell what could happen to the Tesla stock, especially the stock like Tesla. It could go down to 350 in a jiffy, and then you don't want to be buying you don't want to be end up owning it at whatever 430 etc. and the stock at 50. So you did a spread trade, great. Or on the call side, you did a spread trade because you didn't want to limit your upside, so you sold some call spread so that if the stock continues to go to 800, you're still in the game. Perfect way. And I've been doing this. Many of us are continue to do this. So here's an example that I took. Stock is trading at 454, 455. You're selling a put here with 430 and bought a put at 420. Right. So that means if the stock goes down at the expiration, which is 19 December, at the end of expiration, if stock is below 430, you will be assigned this. And but if let's say the stock ends up at $410, the maximum loss that the option spread will trade for, it's a $10 wide, it will trade for $1,000. So you got a $2 premium on the option spread. You lost how much? $800. Right. And then the stock is trading at 410. Maybe you want to pick up the stock at 410, you can pick it up. But the maximum loss in this option trade, if it completely closes in the money, is $8 because you got a $2 as a premium. So $800 is a maximum loss. Yeah, I think I'm okay with it. So I do this trade. And, or you go on the other side, call spread, same thing. The maximum, not the loss, but it would be the stock closes, the value of that option trade would be $1,000, right? Let's say stock closes at 500, 550, because you had a 485, whatever, 485, 495. It is completely in the money. It will trade at $10. That means $1,000. You can't lose more than $1,000 if the stock is trading at more than 495 after all the window closures, right? Even after 90 minutes after the market close. Fair enough? Does anyone dispute with this? Understood?
I mean, I guess I've forgotten my spreads, but short call spread, essentially you're saying you're bearish, but you have a little band in which you want to express your bearishness. Is that right?
Yeah, not bearish. Maybe I also could want to just gain some premium and the stock continues to go
Right.
high. I have a long stock position and will continue to benefit.
Right.
Maximum,
Mhm.
I can, the value of this at expiration, if it is stock is more than 495, it would trade at $1,000. So I know even if I don't sell stock and nothing, maximum I can lose in this option trade is $1,000 if I don't do anything with it, because the brokerage will execute both the trades, right? They will sell this and buy this,
Okay.
and maximum I lose on the option trade is $1,000.
So basically, trading wise, you're saying you will have a confined amount of risk,
Correct.
but tax wise, you're going to show that it's not so.
Exactly.
Okay.
And this surprises some people because you don't focus on the taxes.
Interesting.
So now, because your portfolio won't change much, portfolio will exactly be the way as it predicted it would be. Now imagine, let's come to this case. The stock is sitting at 410. Yes, of course, on option, you'll close your brokerage firm. They will basically close this trade. So you see your portfolio going down by $1,000, portfolio value going down by $1,000, which is what exactly you would expect. But what happens in this case? The way brokerage firm will work this out is they will basically buy the shares at 430 and they will sell the shares at 420, 100 shares. And this is where the $1,000 change in a portfolio will be. But what happens from a tax consequences? You bought it at 430. When you sold it at 420, by default, unless you've actively changed how your tax lots are selected, By default, the tax loss is first in, first out. So when you're 420, you're selling your 100 shares at 420. Remember, you bought it at $50. So in the books, in the tax books, when you're looking at your tax statement, we will show a realized gains of $370. Now you have a huge tax consequence. Basically you gained $370. You had a realized gain of $370 per share. Multiply by 100 is $37,000 of gains on which now you have to pay tax. Assuming you are a tax bracket is let's say 20%, you actually lost more on the taxes than on the option trade. Which, if you are doing a lot more of this, and you think, oh, come on, it's completely in the money. Why do I pay a brokerage? Why do I pay some, let's say you're trying to close a trade and instead of a $10, it is charging in $10, 5 cents. You say, why should I pay $5 extra to close it? Anyway, when the brokerage will basically, both the legs are in the money, and when the both short put as well as the long put get exercised, short put get assigned, long put get exercised. I don't have to pay any trade commissions or no cost. It will be exactly at $10. Why do I lose $5? This is the reason why we should be okay to lose those $5. Because it's not that your portfolio value will change, but you will be hit with a much bigger tax liability, which you will only realize when you open your 1099B in January. And you're like, what the heck? What just happened? So the lesson learned would be, damn, close the trade.
Basically, you have to learn about multiple markets, and this afflicts a lot of kind of money managers over time. Like futures market interacts with option market, option. So right now, what you're describing is taxation of one market, option market versus stock market interacting together.
Yeah, because your option will lead to a stock transaction.
Yeah. We had that kind of a reason for the October 1987 crash, where the forwards that were created and being traded for the first time in Chicago were kind of independent of what was happening in New York and the big gap.
So
I guess short, summary statement is there are two markets. You need to learn about intricacies of both markets, not just one.
yeah, I mean, I'm not even going into, let's say, the future of I'm just saying, understand when an option trade, if you let it go through the expiration period, understand how each of the legs will impact your portfolio.
Yeah, but you're speaking about stock options. What if it was bond options? Then you would need to learn about the bond market's taxation policy, right?
Yeah, exactly. If you own bonds and if you have some option
Fixed income
position,
hedge funds own trade bond options on bonds.
correct. Yeah. So yes, Naresh is saying when this applies only if you have a stock in your portfolio. Yes, because then these stock will get sold on a portfolio. Now, if you don't have a stock, then the way it will work is you bought the stock at 430 and you sold the same stock at 420. Then your life will still be okay because it's first in, first out. You didn't have a stock previously. Then you'll not be hit by the big tax liability. Same thing, the same logic will apply here. Now, let's say in this case, for now you'll have to pay the taxes, but now the new cost basis from the tax perspective will show up as $430. But you were not planning for paying taxes this year. Right? So I understand how, the option trades, when you let them go all the way through the expiration period, could actually impact your tax liability. Doesn't impact your portfolio more than what you thought it would, but could impact your taxes. which you were not expecting. If you had a call spread, same stuff. Your share would have called away at 485, and that means you bought it at $50. You got a $435 of a realized gains on which now you have to pay taxes. And then your new cost basis will be $495 for the shares that you still own in your portfolio. But so your portfolio position hasn't changed much, but unnecessarily you got hit by the tax consequences. So this, because now I started focusing more on the taxes side. So I thought, oh, I myself never paid too much attention to this topic in terms of no change in portfolio. So you'll still all be fine until you get your 1099B and say, what the heck? Why do I have to pay so much taxes? And this is why you have to pay so much taxes. Dave says, you're going to pay taxes sooner or later. The question is when to exit with the best tax benefit. Yeah, so rather than brokerage firm deciding on your tax outgo, you decide. If you're fine saying, okay, you know what, let me take a tax hit this year, and next year I'll have a higher cost basis, that's fine. Then let it go. My only idea is have it as an informed decision and not be surprised by it. One more reason why you should maybe close your trade and not get it all the way through expiration unless you have done unless you have run through your tax impact scenarios. Audrey says, do the tax consequences apply if you trade stock options with your Roth IRA? I think IRA it won't, because there are no tax consequences. You don't have to pay the taxes right now on IRA, but this apply for a taxable brokerage account. But I don't think a lot of people just don't trade options in IRA. Vivek, did you take any courses to understand generative AI? Nope. I mean, I use AI as a consumer. I'm not developing anything on AI front, and but I didn't have to take any courses.
What I mean is to understand how to utilize it to well, I guess basically how to trade stocks or something. I mean, because it says, yeah.
No. So I would not go to AI and tell me how to trade stocks. I have to figure out what works for me, because AI doesn't understand me.
Well,
AI will tell me what are maybe the rest of the people are doing, but it doesn't understand me. So
I have a batchmate who actually has like written up a sequence of prompts and trying to essentially come up with a model which he says works well for trading zero DTE options.
sure.
So it basically looks for information about what's the macroeconomics talk today about XYZ interest rate or some Fed guy blabbering something, and based on that, all kinds of stuff. So yeah, there have been some people trying to just use the text processing that we have in the internet by way of Gen AI and coming up with models.
Yeah, but there's nothing new. I mean, there's a lot of the whole Wall Street is doing all the sentiment analysis text. So I don't think you can.
Yeah, that's very fine-tuned to use sentiment, and I think it works. But this is too hokey, in my opinion.
Yeah, I think Peter Lynch has said something which has stuck with me is, if you spend 14 minutes talking about macro, and I spent some time because, hey, you guys want to know what's happening, not that my preferred way. If you spend 14 minutes on talking about macro, you wasted 12 minutes out of it.
That's good.
Most of the great investors, they don't focus on macro.
For those who trade based on earnings growth, that's what Peter Lynch's comment is absolutely right. But there are people who don't trade on that. So that's why there are 12 hedge fund styles, and one of them is macro-based trading. And those people only kind of bet based on how interest rate, short-term Fed futures will evolve over the next 2 weeks.
Like Ray Dalio is a big macro. There are macro hedge fund traders. very well respected macro hedge fund traders. Not for me. Naresh is saying when option get assigned or closed, most of the broker firm don't get option to pick up the tax lots. So Schwab doesn't do it for you. So especially when the assignment is through the option route, you cannot go and pick up the tax lots, before the next day. So generally you'll have a 1 day in which you can go and change your tax lot. So if you're sold a stock, right, not that it went through the assignment or a exercise process, but if you sold your stock, I can go to the shop.com and I can change, before it gets settled. So I have a 1 day because now we're in a T+1 settlement. I can go and say, okay, these stocks use these tax lots. But if your stock is getting sold through the option route, then you won't be able to do it. So in that case, you have to call up Charles Schwab, and I did once because I called up like, why can I not choose this? And they told me if it comes to the option route, then you can't even see it in your the trade history. Doesn't even show that you sold those stocks, and you can't choose this. In that case, you have to call up Schwab and said, this short call was assigned or whatever, long put was assigned and the stock got sold off. I want you to use these tax lots for this. Otherwise, it doesn't show up. And I don't know if, let's say, Fidelity or the Tastyworks, they even allow you to change it online. Tastyworks does not allow you to change it online. When I asked them, they said, oh, you need to call up basically this number and tell them what tax lot to use. And you can't change it very often. And so right now, I'm like not doing much on the Tastyworks. I'll probably move the capital as and when it freed up to Shop because I do want to control my tax lots application. Fidelity has AI wealth planners. I'm not surprised there will be many more. I mean, like all the robo advising will now become AI advising. Dave says I'm using AI to sort through trading research. Oh yeah, it is. I use AI a lot to do the research on the companies, but I don't outside tell me what I should buy because it doesn't know me. But I'll ask AI to tell me about the company. Then I'll have to decide whether I want to buy it based on my portfolio and me as an investor. Okay, Aditya is asking unrelated question. In a put spread, if I get assigned stock because one of the leg was breached, is it best to close out the other leg manually before expiry? You can hold it until very close to because you are a long on that, and then take a decision of closing it because at the stock could still move right before expiration, and that you still hold the other leg. So, and if you close it before expiration, you're not going to lose more than the width of the spread. So the question is, do you want to close it right now? And then what if the stock moves in your favor and then you don't have an upside because you already closed the other leg? So in these cases, what I do is, Aditya, I will still hold the other leg and wait until the last day because now the stock can't move much. Even if it could, even in my favorable case, it won't move much. And I wait until the last day before I close it. That's what I do.
Thank you very much.
Okay. All right. So moving to the next topic. Hey, I think there are some questions on HIFO, which is highest in first out or swap pair lots. I think what I found is Schwab is much better. In a Schwab, they also have a tax lot optimizer in which it will automatically pick up the highest in first out based on long term, short term. But sometimes you do want to control your own destiny, and I have done this year because I was focused on tax loss harvesting is picking up individual specific lots. Schwab allows you to do it, so which is worked out very well. All right, next topic. break-even revenue and valuation. How much time do we have? We have, let me see, let me cover through the rest of the today's session because this is like timeless. Even if you're not able to cover the break-even revenue valuation, we can do it next week. But then some of the other topic will become stale for the next week. So if you have a time, we'll get back to this one. Okay. All right. Looking at the fear and greed index, nothing. I mean, we are still a little bit in a fear zone, which surprises me because we are what 2% almost close to all-time high, maybe 2% less than close all-time high. But this is basically based on 7 factors. You go to CNN website, it'll explain you what those 7 factors are. And sometimes even though the stock market is at all-time high, maybe the way the calculation works, maybe there are a lot more puts. People have already, the traders have already had bought a lot more puts just to protect themselves, which will basically move this needle towards more on the fear side. Maybe the concentration or the width of the rally is very narrow, and hence it's still on the fear side. So you need to understand how this is calculated. It's not that the market has crashed and that's why it's on the fear side, right? Um, Sector wise, finally, we have every sector in the green now. I remember 2 weeks ago when we were meeting, we had a consumer staples that was still in the red. But now finally, even the real estate is now in green. Of course, it's led by communication services, which is up like 35%. Ignore that. Even if you had S&P 500, it's close to 17%. And you didn't have to pick any sector. You didn't have to think about AI. You didn't have to think about, maybe the supply chain of AI and try to pick a word. Just buy S&P 500 and chill. You don't have to read any annual reports. You don't have to worry about any earning surprises. And you still gotten 17%. Right? So, what are the stocks buys and sells this week? Not a recommendation, but from a transparency perspective, I want to be open and clear. What did I buy or sell? Let's look at for the sells, then I can tell you. So whatever I sold, I just bought ICSH. I parked some of the cash in here. What I got sold? I sold XYZ, which is basically erstwhile Square, to do some tax loss harvesting. I sold a little bit of a PayPal. Again, then I went and picked up the PayPals that I bought in 2020, like 200 plus, and did some tax loss harvesting on that. And then the last one was Unity. I had some shares of it, which I sold to just do a tax loss harvesting. XYZ, I have a short put for January. I think, one sec. Let me go through this. I think XYZ have a short put. PayPal, I think, have a short put for January. Hold on. Let me see. That shows up. Let me just see. PayPal. PayPal. I have a short put for January, which I rolled out on 14th. Don't want to be an eye chart for you guys. And then I also have a short call for 70. Yeah, so I have a short put for January. If it get assigned, it's after 30 days. So won't be a wash loss. So tax loss harvesting would work out. The other one I sold was XYZ. Same as the case with XYZ. Short put got rolled out for December, for January, and covered call at 70, probably at expire, worthless. Third thing I sold was Unity. Very small part of my portfolio. I'm not following that company anymore. I know the stock has done well this year, but again, rationalization of a portfolio, want to own less tickers, and this was one of them that got the X. because it could also help me in tax loss harvesting. So I don't have any open trade on you. Nope, nothing on Unity.
Hey, Vivek,
Yeah.
what's the percentage of SGOF in your portfolio?
Percentage of what?
SGOF, SGOV.
I don't have any SGOV. I only have a ICSH. I put it in ICSH.
It's the
Doesn't
same
matter,
thing.
but what's the percentage right there?
Let's see if it shows up in. It's not in top 15,
It's
so it'll
based on
be.
how much cash you want to hold. Like
So
if you
let's talk about that. Yeah, you're jumping it. The next one is a portfolio pizza.
Okay, good.
So, oh, by the way, I made a change. I think some of you asked that did all my trades show up. So I made a change. So this will show up the next day. These are all the open trades that I still have. It doesn't include my hedges because then it will become too noisy. I do a lot more hedging trades than the actual trades, but these are all the trades on which are not for hedging the portfolio, but premium harvesting. Maybe I want to own the stock and selling a put, etc. So Amazon, Aristanet, ASML, blah, 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 blah. I still have a lot more, man. And I still have some December trades that I need to close and started to build my January. Okay, so these are all the open ones. You could also see last 3 months of our trades. If you go to view all trade, I also changed this so that it shows up all the trades as of yesterday. So now this is sorted day wise. So yesterday, FXI, Google, Palantir, Tesla, XHB, XLF, XLP, XYZ, blah, 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 blah. You can see for last 3 months. If you have questions, bring it here. Sometimes, I don't get a time to share every time on the Slack, etc. So I was looking at it get automatically updated. Not that I want you to follow on these things, but if you want to get some ideas or want to have questions on this, bring it up in this meeting and we can talk about it. Well, I do try to put my comments on why it did this so that you get some thinking why I'm doing this. Like said, I sold XLP put on defensive consumer staple at 30 delta, right?
Do you have a Melly trade?
Melly, let's go to the open trades. I think I have a Melly iron condor and in which probably the short put spread is in the money.
What happened Friday? Why did it drop that much?
Yeah, I have this iron condor which I opened on 11/4. Like I said, there could be multiple reasons. I didn't see any news except that they had raised a debt. There was no other news on Melly. So yes, I have this December expiration and probably, if it closes completely in the money, I would, since we talked about the tax loss consequences, I will close the put spread at a full value or maybe pay a little bit, 5-10 cents more and not go through the tax consequence. Then I'll buy the stock at a cheaper price. But yes, I do have a Melly trade open.
Okay, thanks.
Well, is Melly rumored to split at some point because they're over 2,000, right? Are you hearing any? I don't know. I didn't listen to earnings call, but will Melly split?
No, and I'm okay. Split or no split, I think I'm fine with it. It only helps the option trades. It doesn't have the stock. You can always buy a fractional stock, but if it's split, then options become a little tighter and all that stuff. Beyond that, I don't think it helps anyone. Sometimes sentimental wise, the traders will push the market price up because everyone now can trade in, but a business value, no new value being created by splitting the stock. Only you may be able to attract a different kinds of investors, right? Because like you said, it seems to be, and there are many people who say Melly is expensive. Why? Because it's $2,000 stock. People associate the price of the stock with the, whether it's expensive or not.
The price change in Melly was not greater than the average true range, so it is still within the normal limits. And again, the gamma scalping and gamma adjustment by the market makers can move the market so much.
See, Shri knows much more about the daily movements than I would ever know. Thank you, Shri. Ashwin is asking, I see many short puts open. Do you limit the number of such trade based on the cash you're holding? Say if the market tanks 10%, will you let them be assigned? I'll have to determine at that point of a time. Maybe I'll roll some. Maybe I take some assignment on some. And yeah, it depends on how much. At the end of the day, I'll overall look at what my overall delta will be. Now, what you don't see here, which is something I mentioned, right? Hedging the portfolio. Let's say if the market crashes 10%, those hedges will print money for me. And because
your SCHD trade, is that to own it or is that just to get a premium?
No, if this is to own it.
Okay.
Yeah, I mean, I've been doing this SCHD every month. Right? There are some trades.
This is at the money?
This is 30 delta.
Oh, 30 delta, okay.
Yeah, I opened short put near 30 delta.
But if you want to own it, I mean, isn't it better to sell at the money? Or is the chart consistent that if you sell 30 delta, you're going to get a sign?
No, I think I've been doing 30 delta like every. So even if I want to own it, I don't think I've done many trades which are above 30 delta. Right. So this one, NVIDIA, I did a 20 delta short put, but I had a covered call against 215. So now this has become a strangle. Oh, so now you can see both. So NVIDIA has become a strangle. 12, I opened a covered call at 16 delta because this was premium harvesting because they're doing at 16 delta. I really don't want NVIDIA to get called away, but I want to obtain a little bit of a premium. So I did a 16 delta. In NVIDIA, I really don't want to get assigned. So I'm like, okay. And it had moved a little higher. So I did a 20 delta, converted it into a strangle. Neo almost delta neutral strangle. Yeah. So SPX, this is the stuff which was, we talked about it, right? Box spread, which is I got it at 4.38% APR. Yeah. So these are all the open individual ticker non-hedging trades.
Yeah. See, last couple sessions you talk about this SCOF, right? That's like, yeah, I'm probably gonna follow suit. So I threw 100,000 in there. I was like, 100,000 only give me 4,000, which is only 4%. Is that the best use of my money right here?
No, so here's the deal. So cash is trash until you really need it. It's like oxygen. Nobody thinks about it unless we are devoid of it, right? So again, I've been again depends on how your portfolio has performed, and for me, I've done much better than what I expected I would do this year. Again, we still have 3 weeks to go. In both of my trading account, if I combine together, I'm up like 30% YTD. More, and I'm like, I don't have to become more crazy. Right. I think these are the last 3 years have been the best 3 years for me personally. I'm like, so if I'm raising cash, then I'm holding it in ICSH. If I was 5% or 10% up over the year, maybe I would have still held and saying, oh no, let me try to squeeze in something more from the market. I just don't want to be too greedy. I'm like, I'm already made. Again, maybe I'll end off. I'll share. I generally don't want to share the number, but since you asked about it, is the cash best use? No, but I don't want to be too greedy. I'm up more than 30% on YTD. I don't have to be too greedy. So this year I'm okay holding a lot more ICSH because I want to make sure I have enough cash to run the household for 2026 if the market corrects. I don't want to be selling the stock then because I need bills to pay. I would rather be selling the stocks, doing some tax loss harvesting today when I'm up lot more than the market, keep the cash to pay the bills for the next year, because next year market goes down, I have a need for a cash, then I realize this is oxygen I needed and I didn't pay attention to it, but now need it desperately. That's my reason. That's why I tell, don't follow me. You don't know what my situation is. Mine is
Yeah,
different than yours.
different purpose, right? Yeah.
Yeah, different purpose. Yeah. If it even it earns 4%, sure. This year has been good for me. I don't need to look for another 10%, 20% stock that will give me another 10, 20%.
So Vivek, this 30% ROI is on your entire portfolio for year to date?
Not including my retirement. I still have to run that calculation, but it's both my trading account tasty works as well as Charles Schwab.
So essentially, I guess what I'm looking for is like, every single dollar that could be exposed to some form of risk, which is bond risk or stock risk or whatever.
Everything which is in my investing,
Okay.
these two
So
investing
30%
accounts.
is very good. 30% is very good.
I've been lucky. I did not expect this, especially after the last two great. I did not expect this, but this time Chinese stocks helped. Right. So there are some stocks that I own in my portfolio were duds. Jumia has done great this year. A lot of stuff came from the Chinese stocks have done great this year, which didn't do anything in 2023. So I would say I've been lucky. Right.
Into the year, I was heavily into bond exposure. So my run started only from April, May.
I've been tracking for last since I think our data started since 2017 or 2018. And this, I'm like, so right now, okay, let me make sure if I can get some cash to pay my bills for the next year, I'm okay to raise that cash and sit on the side. I'm focused on not doing stupid things. I'm not focused on doing good things. This is a different way, right? Invert. I'm not focused on buying or doing good things for the next 4 weeks. I'm focused on not doing stupid things. So anyway, that's enough about me. I just want to share my portfolio. Pizza. Only thing that have changed the big thing that have changed in the pizza was Google have dethroned Mercado Libre after many long time. I think Melly was my topmost single position for many years. Now the Google has taken over the spot for Mercado Libre. And if maybe Melly goes to 2200, it will switch again. Who knows? We'll see then. But at the end of November, this is my position. SCH nothing else changed in the overall leaderboard.
So have you over the years, because I know you have Melly since COVID, right? So have you over the years reduced the number of shares across your portfolio?
I had done one stupid mistake way back in, I think, before COVID. I think I did Melly in 2018. That's the first time I bought Melly at 350, 360, that point of a time. And in 6 months, the stock was like around 580 or something. And I did a stupid mistake of no one has gone broke taking profits. I wasn't educated. So I sold some Melly. No, I didn't sell. I actually had a call on that. And then my call was in the money. I'm like, let me sell some stocks because, hey, it has gone up and no one has gone broke taking profits. So I sold some. And then I started buying after that. I think COVID, I started buying again. And I don't think I ever sold Melly after that.
So I mean,
since COVID, after my initial mistake, I never sold Melly.
In your last few sessions, you talk about, you learn from the mistake that, if a stock is good, meaning that from a business perspective, fundamentals are strong. Don't sell it, hold to it, right?
Yeah.
But also there's all this other stuff out there, which means that, hey, the 2026 cycle, we might be going down. So where do you balance that?
So if we may be going down, that's why I'm raising cash. I don't know if we will go down. We may not. If we go down, I want to make sure I have enough cash available for me to run my, to pay my bills so that I don't have to sell the stocks.
But you're going to hold on to your long-term stocks where you believe the business values. Okay.
Yes.
By the way, I just looked because I was trying to figure out whether there has been currency tailwind for you, Vivek. So EWZ, which is the Brazil index, is at all-time high, has been going up steadily over. So perhaps that also helped you, right? So
Yeah.
currency is one of the important. So essentially, the lesson
No,
again
but
is
no, but if you look at
diversification.
Mali's, I think the currency neutral results also have not been, you know, did I get some currency headwinds from it or tailwinds?
Is this
Yeah.
an ADR? This is an ADR traded, which has got money in Brazil reais, right?
Yeah, Real and no, Argentina is also bigger one. Brazil is not that big, but Argentina is a bigger market for Mali.
Okay.
And again, but the Meli stock hasn't performed much. So right, so from if you look at a Meli, that hasn't been a great winner for me for this year. I think it's been mostly sideways. See, let's go to 1 year. Year to date, Meli is up 17% only. It's done as much as S&P 500 has done. I could have just owned S&P 500. Right? It's done 17%. This is not an outperformer. But some of the other stocks, that have outperformed, Jumia is one of them. It's up like 200%. Some of the other stocks, let's say Baba, Chinese stocks are done well, 86%. Google I own, which has done well, 65%. So yeah, we got lucky. So, but again, every year won't be like that. And I'm not saying it's all because of skill. There's a huge amount of luck involved in it. But then I don't know what the future will entail. Only I know what I have to 2026. I need money for my expenses. Might as well, start preparing for it. And if, let's say, the market continues to go higher, will I repent that I did some tax loss harvesting on some of my stocks, which have now gone higher in 2026? I don't want to, because my portfolio will still be higher, much higher than where it is today.
So what 2, 3 things you saw in Meli at your first purchase? I've never invested in this name, so.
I saw that when Amazon was growing up, I wasn't in US, I missed the boat. I got onto Amazon boat very late. And then I said, if I'm looking at some e-commerce companies across the world, I want to own them. If the business is doing good, I want to get on that boat, early. That's why I invested in C Limited. When the C Limited crashed after 2022, I've been watching C Limited since COVID, but the stock was too expensive for me to play into that. But when it crashed, I think I did my buy at 35 or something. First buy, and then I kept buying it. That's why I started building position in C Limited because it's on Southeast Asia. That's why I'm in Coupang, because it's the Korea, Taiwan, and now Japanese market. That's why I'm in Jumia, because that's an Africa e-commerce market. I want to own e-commerce because that's at a larger level across the world. That's a secular tailwind.
That's true.
Year or two, things could change, right? 2021 during the COVID, every e-commerce stock was up because of obviously everything was shut down. Then we opened in 2022, 2023, e-commerce stocks came crashing down because we're opening. But secular tailwind is there across the world. E-commerce will grow. Maybe some saturation in US also still not.
What do you think? What do you think is the percentage penetration of the total addressable market for e-commerce today? I mean, that it started like around 2005, right, with eBay and but you're right. I mean, I totally agree with. I feel in my bones that it's not penetrated enough because I work in this space of e-commerce. Like a Walmart.
You know more than me then.
No. I'm actually not in this in the front end, but in more machine learning and stuff like that. But I feel in my bones that this penetration of the usage of e-commerce stuff is not yet complete. From a business MBA people talk called TAM, total addressable market. Lots of people don't use e-commerce that much yet.
Yeah, that's what and they will start to use it. I mean, in US, we started on the US side. So there's no reason why this should not get used in the rest of the world as internet penetration improves and as rest of the infrastructure improves. In a companies like, and there are other e-commerce companies also in Africa. I mean, Jumia is not the only one, but that's the only way I could get exposure to it. Right. So I'm like, okay, I want something to own in Africa, and this is a company I can own. I bought it, and I've gone through the huge. It's not been an easy journey, right? It's gone through a huge ups and downs with this company, and I'd almost given up on this after the like fourth or fifth strategic business change. Then I thought, okay, now they got a new CEO. They pushed out the co-CEOs, the founders. I'm like, okay, let me give this new guy 2 more years. And that new guy has delivered. So now I started building more on it. I think last year was the first time after long years that I added more to my Jumia because I'm like, I think the market is not reading it correctly. I think I added 25% more to my portfolio. But it's not been an easy journey. And still it could go down to zero. It's still not big part of my portfolio yet. It doesn't even qualify to be in top 15 yet.
Is that considered timing the market or no?
No, I've been owning this company for now 5 years.
Mm.
Right. And I will only add because this is a part of my moonshot, moonshot, right? Which means I'm not gonna dollar cost average in it because the business is not that strong yet. It's got a lot of potential, but we don't know if that potential we realize or not.
So a quant would actually evaluate the returns of Meli relative to its appropriate benchmark, like say Latin America Index or EWZ, and see if there's an actually outperformance of Meli relative to that.
Let quants do it. I don't know. So,
You just have to go with your instinct and what you're interested in investing. The quants might not be correct.
Art of money management, which was there since the 70s, but it's turned into more of science, which is what Citadel and all these other funds do. But anyway.
Yeah, just follow them. Don't have to worry about us.
Yeah, I mean, different. There are many ways to skin the cat. Figure out what works for you.
That's exactly the right approach that I would go.
Yeah, I've made mistakes of trying to follow what other people do, and now I'm trying to reduce a lot of consumption from. I listen to people from information gathering, but not for decision making. All right. Any questions on the portfolio? Otherwise, at the end of after the first session, after end of December, I'll share the portfolio again. If you are following me on Twitter or X, I post it at the end of the day of the last day of that month. But then I have to wait for our meeting to share with the rest of you guys.
Your turkey pie, I like that on your Twitter.
Oh yeah, I was like trying to do something different, I asked. That's where I use Gen AI. It got a few logos wrong, but I said, yeah, overall it does convey the theme.
Yeah, but I didn't see Melly in the turkey pie though.
No, the Melly would be there. Probably didn't pick up the right logo.
Oh, okay.
Yeah. So, and I was like, I actually told it, but I think I tried both on Gemini as well as a Chat GPT. The damn thing didn't correct it. I'm like, okay, whatever. Where was that? It should have been.
I signed up in Twitter just to follow you.
Oh, thank you. I'm flattered.
I haven't been back on Twitter for a few years now. So.
Oh, there
you go.
So Melly should be here. I don't know.
You got cut off somewhere, right? So
yeah. Jumia has got XLE.
So is this all your portfolio? Because there's tickers in here that's not in your top 15, right?
Yeah. So again, I don't think it got it got everything. Now the EXONB, I don't even know what this is. I don't own this. I own
Yeah.
Pinterest. This TSPAL, I think, is wrong. I don't know what this
So
is.
that's
Maybe
interesting. You
PayPal.
own all this stuff right here.
This
Yeah.
is PayPal, and this is Apple. I don't own Exxon, so I don't know why it got Exxon, but it's a little more fun. So don't don't take this as my portfolio. It got a few stuff wrong,
Yeah.
but I was just looking at some fun way. All right.
So Vivek, you said you wanted to invest in e-commerce, right? Have you invested in Indian
Sorry.
e-commerce
No,
businesses?
your voice is very muffled. I don't know. Is it just for me? I can't hear you clearly.
Hold on, let me change that.
Muffled.
Okay, let's go to the crypto, and then we will open up the breakout rooms. So the revenue stuff and using that as a valuation framework will probably cover later session. So from the crypto side, Bitcoin was below 90K the morning when I took the screenshot. I don't know where it is right now. So let's see. Yeah, it's still the same. So it hasn't much changed, but who cares? On the some day-to-day pricing, yeah, Jose said it's been a sideways chop. Yep, that is true. We've been moving sideways, but few things that I noticed, which is bullish in the long term. I don't know what's going to happen tomorrow, month, or 6 months, but Vanguard has finally capitulated. So Vanguard chief now says, so this is how it started, right? In 2018, you will never see a Bitcoin fund from us. Even when last year, when the ETFs were approved, Vanguard was saying, we will never allow these Bitcoin ETFs on our platform. So we don't say that they have any inherent value. Anyway, but this week, they capitulated and saying Vanguard will now allow its crypto ETFs on its platform. Market acted very surprising. Bitcoin is up, I think, not just this news, but there are a few other news. But this was one of also a big factor that Bitcoin was up like $3,000-$4,000 on December 1st after this news came out. But if you've been following the changes that have happened on Vanguard side, won't be that surprised. So Vanguard got recently a new CEO. Recently means maybe 6 months ago, Sunil Ramji. He came from BlackRock. And he was the guy who was instrumental in BlackRock's IBIT ETF, which is a Bitcoin-based spot ETF.
Really? I didn't know. Okay.
Sunil Ramji was one of the team members who pushed BlackRock
That's sad.
for IBIT. So when he joined Vanguard, I'm like, it's a matter of time. It's not if, it's when. And see, at the end of the day, you will see you can't have BlackRock make so much money on their Bitcoin ETF that it has turned out to be the most successful ETF for BlackRock of all times ETF.
Really? Wow.
It's only like a 1 year old. They made so much, it's like $100 billion under it.
They've been pushing all the clientele to, that story that, hey, you should have 5% in that coin.
No, BlackRock doesn't have many financial advisors. So BlackRock can't do it. So
No. Yeah.
it's not into financial advising stuff.
Right.
So they can't tell the clients what you have to buy. But another one which we saw, and this also one of the reason why maybe we saw, and these all, both the news came on the same day. Now, Bank of America has now sent out a note to its financial advisors. And the overall, I think they have a few $1 trillion. The advisors have a few $1 trillion under management for their clients. And what they said in their guidance, for investors with strong interest in thematic innovation and comfort with elevated volatility, a modest allocation of 1 to 4% in digital assets could be appropriate. Now, this is a huge deal. Now, if you are using, I hope you are not using financial advice for a Bank of America, but they'll charge you 125 basis points for buying S&P 500, which you could buy yourself. But in case if you are using it, Now those guys will be talking to their clients and say, you know what, I got a new asset class. We talked about stocks, then came bonds, then we have REITs, but now we have a new asset class on which I can invest some of the assets. It's going to be a little more volatile, but over long, like 10 years, 15 years, it has returned much more. Maybe I'm going to put only 2% of into your portfolio. Now they can do it. Till today, they were not allowed to do it. And now if these financial advisors start bringing in Bitcoin into the discussion with their clients, and remember, and coupled it with the generational wealth transfer that's going to happen from boomers to millennials, I'm still bullish about this ecosystem. And there was another, long back I read another, I think, survey around the financial advisors. So fun part was financial advisor says, we hold some of these Bitcoin ETFs in our own personal portfolio. Like if I'm a financial advisor, I own this on my own personal portfolio, but I can't give it to my client because we are not allowed to, because it will go against, my risk management will flag it and all that stuff. Now they can. Right. So this also, I think it's a bullish.
But I think the allocation recommendation has been going down over the last 12 months.
No.
If it used to be 5% or more, I think I saw in print 12 months ago, but now it's like 1%, they're saying.
No, I've never seen more than 2%. 4% to me seems to be on the higher side. So at the 5%, you may be referring to the guidance from Cathy Wood to the corporate companies to have it as a treasury.
Okay. All right.
I think that number I recall, that Cathy Wood, and basically they're saying they ran their own simulations, Monte Carlo simulations, around if the companies, instead of putting all their treasury fund, the general reserves for the treasuries into US treasuries, instead of putting that, if they had put 5% on Bitcoin, their balance sheet would have been much, much better shape.
But she doesn't have any concept of what's called risk management, which is a big science. Because they haven't looked at the negative returns of Bitcoin on a month-to-month basis over 10 years. And then,
hey, it comes with the volatility, right? So you need to be okay with but if you're putting only 5%, right, then even if the asset goes down 50%, it's like a 2% hit on your portfolio, right? More volatile the asset is, better you need to make a decision in terms of position sizing. But anyway, so this...
I was not into Bitcoin altogether. I felt that it was something of a fake. But now I have started investing in Bitcoin only because it has fallen down almost 30 to 40% now. So this is the time that I would get in and wait for a longer time. If it goes down another 50%, I would not be concerned about it. I will leave it alone and wait for it to come back up. That's my type of investment style.
What are you holding?
The future.
Oh, the future, Bitcoin futures. Okay.
Micro Bitcoin future.
I hope there are no Bitcoin maxis here. They hate these people like you and me who hold paper Bitcoins. So, but yeah, I mean, 30% drawdown in this Bitcoin ecosystem is nothing. It's like a walk in the park. Right? There have been many instances where we have seen this down a couple of times, like 80%, 2013, 27, after 2017 high, we have got 80% drawdown. 50% is like normal. So if you are touching this ecosystem, you have to go to be comfortable with the volatility and the fact that it's still, how should I put it? It still is a part of a moonshot.
Yeah.
I still consider that if it doesn't pan out, it could still go down to zero. Who knows? There is a minor probability. Not big, but if nothing works out, we don't see the use cases. Let's say store of value doesn't pan out. Let's say the quantum stuff comes and breaks it. All the first that we are hearing, there is a minor probability. So position size it accordingly.
We just have to get MicroStrategy to a level where it's compelled to sell its stuff. That's what I'm
That's
waiting for.
another. That's
I'm
another
waiting
beast.
for that to short it. I missed this shorting opportunity in the last 2 months.
I don't want to go against Sailor. Don't want to short it.
Oh, really? Okay. Good.
Dude, yeah, I don't know what next financial engineer he's gonna do, and there the whole Reddit crowd will rally behind it. I don't want to short it. So for me, this is one of those like not do stupid stuff is not short Elon Musk, not short Michael Saylor. Rather, I think I've given I'm not gonna short any individual stocks. Plain and simple. One rule. Do anything else. Maybe buy a put or do a call spread. Not gonna
Are you
nickel.
gonna go against Michael Berry?
By the way, Michael Burry was on a podcast with Michael Lewis. I think he has done his first interview after the big short fiasco, after the 2008-2009 financial crisis. So go give it a listen. It's a 30-minute interview on Michael Lewis podcast. I think his podcast is also called The Big Short, something like that. Yeah, give it a listen. So he does talk about what's in the market and all that. He also says, why close it fund and everything else. All right, so a few more things on the crypto side. We had our Ethereum's Fusaka upgrade that happened on Friday or Thursday, forgot. Again, on L1 chain, these are the two big ones, right? There are like Bitcoin, Ethereum, Solana. You can go down to the top 10 list. You'll see these names: Bitcoin, Ethereum. This is a stable coin, BNB. Again, XRP. XRP is up. Solana, Tron, Doge is still hanging around, and then Cardano. But anyway, we saw Fusaka upgrade. I'm not going to go through the details of all, but at a high level, there were like three kind of improvements that were involved. One is, this is a big one. This is carrying forward the work that they've done in the Duncan upgrade, the previous one, to help layer 2s post more data into the layer 1, make it faster and all that stuff. There were 3 EIPs for it. Then the focus on making the layer 1 Ethereum blockchain itself faster, because one of the criticism that crypto community has around Ethereum is, guys, you're given all the power to layer 2. Why would I want to own Ethereum? I would rather focus on Arbitrum or Optimism or Polygon or bunch of like Base, bunch of the other layer 2, which makes, because you have made them a lot more efficient. Rather, I own those assets and not own L1, not on Ethereum. So they've also been working, and I think Vitalik has also mentioned that they're going to be focused on scaling L1 itself. There are a bunch of stuff that happened on the L1. What's most important for me in this upgrade was improvement in UX. Because one thing, if this has to become a part of our daily lives, UX has to improve. The transactions need to be quick. I don't have to go and open up another app. It needs to get integrated like in my wallet, like how the payment systems are. This should be part of my Apple Pay. So there are a lot of tech stuff, but this is where they're saying we're gonna add a native support for, if you're using Apple iOS, they're gonna add a native support for using iOS for cryptography, or if you're using Android, they'll use that. So basically, make it more easier to create the wallets and onboard it, and make it more integrated into the devices that we already use it. That's the biggest one. Again, have at least 10 years worth of patience in Bitcoin or Ethereum or any of these new technologies. Just like you need to have a 10-year patience for e-commerce thesis to play out, at least 10 years patience for the thesis of tokenization, which Larry Fink keeps talking about, store of value or whatnot for this to play out. So this is not a get rich quick game, even though some people have been able to. But for me, this is a really, really long-term play. Just like I have a long-term play on e-commerce in South Asia and in Africa, this is a really long-term play for me. But we have a new Wall Street people who have now got involved into it, and Bitmine Immersion Technologies chairperson Tom Lee, he was presenting a slide. I mean, he presented a bunch of slides. He had a presentation in a Bitcoin conference recently, and among other things, he was talking about ETH. And Tom Lee, he's like, go. He's like a go kind of a guy, right? So he gave his own Ethereum price prediction based on where the Bitcoin could be, right? So there are like two variables involved in it. So Bitcoin could be in 250K in 2026. I don't know what the probability of that would be. And then if you look at an Ethereum to Bitcoin ratio of 0.04, then Ethereum should be trading at 11,000.
We really need an economic recession of 2010. We haven't had an economic recession at all for 16 years. So
yeah.
That's why all these kind of pronouncements are coming. That's the problem.
Yeah. See, so Tom Lee
people have never been through a 60% drawdown where everybody who holds Bitcoin will be compelled to sell.
Hey, 2022 was, for when it comes to crypto, we had already a big drawdown in 2022. Don't tell this to crypto community that you've not gone through drawdown.
Excuse me, who was the last speaker? In 2016, let's see, Bernanke and let's see who else, and two other executive government officials were telling that the market's gonna has in the next recession. There's less tools to come out, so they've been crying wolf since 2013.
No, I know that basically earnings growth in S&P has carried us so far, which is great for USA. But there will come some other factor which we don't know, as I say, the unknown.
It's always, sometimes there is a new reason why the market will crash, will get into recession, because things that we know, we kind of already take care of it. It's always something new, and we don't know. So earlier we were thinking probably it's going to be private credit. Maybe the pin that burst the bubble might come from private credit side. At least that's some stuff which I'm hearing, because
a lot of people are buying this stuff on a firm and all, and that shit is being bundled into so-called private credit and being peddled to it.
Yeah.
So, Vivek, what about the fact that the cost of living in San Francisco Bay Area is twice the cost of Hong Kong? Where's the pop there?
We are comparing different things. People don't want to go and live in Hong Kong.
No, I want to live there, but what I'm saying is Hong Kong and Singapore and Paris were supposed to be the most expensive cities. Now, Singapore, the cost of living has gone up a lot in the past 5 years, but Hong Kong hasn't. So what I'm saying is there's a bubble there.
But
do you see anything?
I don't occupy myself in terms of inflation, etc. At a macro level. Great companies will figure out how to make money in high inflation or low inflation, and that's what I'm focused on. Yeah, does it pinch me when I'm for paying my bills? Yeah, but then that's what I have to figure out, to get prepared. I can't control it, and if I don't control it, I don't want to spend too much of my brain cells thinking about it. Let me focus on what I can control, which is my portfolio.
So Samuel, are you the person who spoke about this, right? Hong Kong versus here. So basically, just like in case of stocks, one can look at the price to earnings of a house, typical house. So the earnings over here, the denominator is basically the a high level earner who is being compensated in growth of the stocks which they work for, like Google and so on. And these people, when they go get a loan, mortgage loan, they're able to show 500K, 600K of income. I was told this about by a loan broker. So not their base salary of 200K, but they add that remaining in order to assign them loans. So basically, that's the reason I think the PE ratio of a typical house in the Bay Area is not that high compared to Hong Kong. Hong Kong,
Okay.
the E would be very low.
Okay. All right. So I think let's finish this topic. Then we'll open up the breakout rooms. And then we get a lot more discussion on this one. Okay. So where was? Yeah. So if you look at the ETH to BTC ratio of 2021 high, then he's saying it should be $21,000. But what if the ETH become the payment rails? Then he's like, okay, then it could become a 1/4 of a Bitcoin market cap. Then it will be 62,000, right? This is, okay, I've not covered about the valuation framework, so I'll refrain from using those words. But this to me seems like a fairy tale right now. There's a lot more need to happen for it to become a payment rail. So ignore that. I think this was too much of this. Could this be possible next 2-3 years? Maybe. But this is also dependent on Bitcoin hitting to $50,000, which we don't know what the probability is. So right now we are multiplying two probabilities. First, the Bitcoin has to hit 250K. And then the ETH BTC ratio has to come down at 8-year average. So now you can run your math on saying, okay, what's the probability of this hitting $12,000? But after this chart on X, I see everyone pumping ETH saying, Tom Lee said that it's going to be $12,000. Come on, he did not say that way. He's using it in relation to BTC, which we also don't know. What if the BTC hitting 250K is only 10%? Then this is like all crap. But I thought I'll share with you because on Twitter, the words could be misconstrued to promote whatever the poster has an agenda to. Or I think there was a question from Niankai while she had a phone trouble. Let me see. I saw it and forgot about it. Have you considered investing in any Indian e-commerce business? So I would if it is trading on the US stock exchange. Unfortunately, the Walmart is the only one which has got a stake in Flipkart. Right. Other than that, if you're aware of something that trades on the US stock exchange market, which I don't know of, maybe do let me know. I would want to take an e-commerce stake on India. Right now, my exposure on India is with INDA, which probably if those companies become big, I will get exposure through that. But I don't have direct stake in any India-based e-commerce companies because they don't trade on US exchange. There is no ADR for that. Now, I don't know what the market makers, but they are over. I've been trading holding INDA for many years, but over, I think this year, I'm seeing the bid-ask spread has become too wide. So I'm looking for a new ticker. If you guys know of India specific ETF.
IFN. It has a huge amount of dividend yield though, so it messes up your.
It has no options, so forget about it. It has no options. So I'm looking at, because again on INDA also is one ticker where I will generally have trade open, right? Again, moving outside of US. So yeah, I have this triangle open, 57.53, short put near 30 delta. Bid spread is crazy wide. Yeah, I'm looking for a different ticker. How come you have added BYD when it's got no options play? Good question. Because now I will hold BYD. I wanted to get an exposure to Chinese EV companies. I have NIO, I have Li, but then BYD has become the biggest and the strongest player. And hence I wanted to add BYD, but I'm going to keep my position size, assuming that I have no way to reduce my cost basis in this. So I added BYD recently. That's the reason I want to own instead of Oh, yes, and Xpeng too. Yes. Sorry, I forgot about the third one, Xpeng. So I have these four. Again, Chinese market is very fragmented. So I don't know whether Xpeng is going to win or not. Xpeng, I hold it because of their eVTOL. Lee, I bought it because Lee is the only um, you know US traded Chinese V company that was actually profitable. And Neo added because that was the first ticker that had options, and I started trading in it since 2019 or 2020. And I own it like free and clear. I've sold so much option on it that my cost base is less than zero, so I'm still holding it. But BYD is the biggest in the business, biggest in China, biggest of all these companies, like a Tesla. I mean, it's bigger than Tesla. They sell more cars than Tesla. So I wanted to get exposure and couldn't find any other way. So I relented and bought BYD even though it doesn't have options. So that's the story on BYD. Apart from the sad story that I bought it at $6, I sold it at $9 way back. Then I didn't even have a TD Ameritrade account. So probably it was before 2016. You know me, I made 50%. But then the stock went to what? $30, $70, $80.
Are you still holding the ETHA?
ETHA?
Yep. You have it right there. Yeah.
No, ETHA, I don't think I have a long stock position. It's just been option trades.
Okay.
I don't think I have ETH.
That's Ethereum, yeah.
Yeah, I have a ETH in my retirement portfolio.
Mm-hmm.
But again, not big enough. Otherwise, it would have shown up in top 15.
I think it was $23 now, right?
Oh, ETH, yeah. 22, 23, 23. All right, I think that's it for today. Anything else for a common interest before we open the breakout rooms? Any other topic you want to touch upon? We already spent 2 hours 45 minutes, close to 2:45. So it's awesome. Thank you for joining. We are all learning. I'm still learning from my mistakes. So this time I also started to learn from other people's mistakes. That's why I started that book.
So you're a fast reader?
No, I want to, but
how long does it take you for you to read a book?
It's also depends on how much time I spend on it. Some books, if they are not that interested, have taken me long. Like expectation investing. Remember, I think few weeks ago I told you I started expectation investing and then another book at the same time. I've only done like half of it, Michael Mauboussin book, because that's very heavy. Expectation investing. And in between, then I studied 1929 because I like a lot more story weaved kind of a book. And this, the one which I'm reading right now, that's even in more simpler language and much fun to read with. It has got like pick up one investor, talk about it, and then chapter is over. Michael Mauboussin, if you read his papers, are heavy. They talk about real stuff, right? It's not a story. And I mean, he's a great guy. He teaches on Columbia. Even Warren Buffett admires him. So his book are heavy. It depends on what kind of book it is and how much time I'm able to spend on it. But I don't put any target on myself. Say I have to finish this. It's make it a little fun for me.
Sounds good.
All right, so let's open up the breakout rooms, guys. I want to talk about anything else, get deeper into some subjects that I haven't been able to, I don't touch upon, or probably I don't know more about those things. There are many other people who are a lot more knowledgeable. So go and find people of your tribe.